Hey everybody, back with another video, and today we're going to be talking about what you can do with the cash that you've got sitting around in the current economic environment. As you all know, I'm still quite sketchy about investing in things like equities and other high-risk investments with a large portion of your portfolio right now because of the current economic environment, specifically the interest rate environment and the inflation that's around. So we're going to look at a few vehicles you can use just if you've got cash sitting around. You don't want to go into anything risky, but you still want to get at least a little bit of reward. So without further ado, let's get right into it. The first thing, which I know I harp on a lot, but some people still don't listen, is you should have a high yield savings account by now. This is the basic basis of what you should have if you've got cash sitting around. For an example, I use Ally because they're just someone that I've used for a long time, so I trust them. As you can see here, sitting at an annual percentage yield of 3.4%, not too shabby considering, during the height of the COOF, 2.5 years ago, you were only getting about 0.5% even on online savings accounts, let alone brick and mortar savings like Chase, Bank of America, which are still yielding essentially nothing. So look for a high yield savings account. You're going to probably have to look online. There might be some brick and mortar places, but for the most part you're going to be looking online. Another example would be Capital One. Their savings also 3.4%. This is right around a rate you're going to want to be looking for right now. 3.5, 3.75%. You're going to be able to find some that are a little bit higher than that, maybe around 3.75, some getting close, and maybe even over 4%. I haven't seen them, but I've heard that they exist. But you do have to remember that with some of those there are, caveats. It only goes up to the first 10,000, then after that it's only, 0.3% or something like that. Or that might be a very small online bank that doesn't have 24/7 customer service, stuff like that. So make sure you research whoever you're going to look at. This is your money. You want to know who's holding it for you, who's paying you that interest. But if you can get around 3.5%, that's nothing too shabby, nothing to shake a stick at or anything like that. Also remember that you want to make sure that there are no fees, because if you're getting any kind of maintenance fee on your account, that's going to be eating into whatever return you're getting. The other good thing to remember is that there is essentially no risk with a savings account. They are FDIC insured up to your insurable limit, which for most accounts is going to be $250,000. So remember that. Also remember that pretty much every savings account is going to be taxable. So if you're in a high tax bracket, think about what you want to do. Make sure that it works for you. Stuff like that, how much you want to keep in there, where you want your interest to be, if it's going to push you into a tax bracket, things like that. All things to consider. Just make sure you do your research for yourself and the account you're looking at. After that, something that has really come back into style over the last 6 months that we had been told previously were essentially dead are CDs, certificates of deposit. With the rising interest rates, not just savings accounts, but CDs have also skyrocketed in terms of yield. As you can see here, with Ally, you can get 4.25% for anything over 12 months up to 5 years. Quite a nice yield, much better than, almost 1% better than just a savings account. And if we go over to Capital One, we can also see that things go up. For example, they have an 11-month CD at 5%. 5% APY on something that is essentially risk-free. It's FDIC insured up to your limit, about $250,000, which for pretty much anyone out there, and it's going to be per CD. Pretty good, can't beat that. Now, this one, for example, is a promotion. It runs out, I believe, on March 14th. Yep. We can see that March 14th, 2023. And we can see that they have other CDs that are a little bit longer, but are also smaller in yield. You can see 2-year at 4.3%, 5-year at 4.1, which makes, they think that rates are going to go down over the long term. So just think about that. Again, these are going to be no risk investments. They're insured. They're going to have slightly higher rates, or in some cases quite a bit higher rates than your savings account. But remember, you're going to have to lock up your money for that amount of time. You're not going to be able to touch it for 11 months or 2 years or 5 years unless you pay a penalty. Depending on who your CD's through, it might be, you have to pay 3 months of interest or 6 months of interest or a year of interest, depending on the length of your CD. The good thing about CDs is you can use them to build ladders. If you want money to come maturing, you could get, an 11-month CD, a 2-year, and a 4-year, and a 5-year. You have money maturing, so you're getting that money back, and you can reinvest it as you see fit. And depending on how you think interest rates are going to go, you can also plan for that. If you think interest rates are going to go higher, you think inflation's going to stay high, they're going to have to push interest rates higher, you might go with a shorter term CD CD, 11, 12 months, maybe 2 years. That way, when that CD matures, you can reinvest at a higher rate. On the flip side, if you think rates are going to stay the same or they're going to go down, you can go for a longer duration CD for like 5 years, 6 years. Some places will go up to like 8 years. And in that case, you're going to be getting that 4-ish, 4.5% for that amount of time. And if their newer CD rates drop down to, 2%, 3%, less than that, because rates have been cut, then you're still going to be getting your rate. You won't have to take a hit because that rate is for the duration of the CD. CD rates don't change with interest rates if you already have the CD, only for the new CDs that are issued. So also make sure that when you're looking for your CDs that you don't see anything sketchy like that. Now moving into things that technically have risk but essentially don't, we'll go into money market funds. I'm just going to have an example here. This is VMRXX, which is the Vanguard Cash Reserves Federal Money Market Fund. There are literally thousands of money market funds. This is just an example. It's one that I use, so I'm going to use it as an example. As you can see here, we're getting a yield of currently about 4.5%. Now, money market funds have to calculate their yields a bit differently because of how short-term the debt is that they hold. So you'll get a 7-day SEC yield, but this number is going to be relatively accurate going forward if things don't change. Now, it will be adjusted if the yield changes from day to day because interest rates suddenly drop overnight and all of the new debt that they're getting is really low. But for the most part, it's going to be around that number if you started right now with your investment. With money market funds, these are invested in things ultra short-term debt. This is going to be stuff that pays out in less than a year. A lot of it is going to be much less than a year. Some of the debt that they hold is going to be matured within 30 to 90 days, so also very good. Very low risk. These are things that are not going to, very unlikely to default. If they do default, it's crazy. In the history of money market funds, only 2 funds have ever broken the buck. That is, they've dropped below their $1 net asset value price. Aside from, and both of those were very iffy situations where they only happened because they were poorly managed. For the most part, these are never going to lose value. Their reason to exist is to maintain that $1 share price, and your only returns you're going to be getting from this is your yield. As we can see going down here, with the composition, you see it's treasury bills, government obligations, and repurchase agreements, which is essentially extremely short-term debt, things that are collateralized with U.S. treasury bills, stuff like that. Very safe, as safe as you can get that isn't insured. And as we can see here, they are very liquid. Your daily liquid assets, which is going to be assets that will mature in less than a business day, is over half at 57%, and I've watched this for the past few months. It's always been over 50%, often over 60%, and the debt that's coming mature in a week is over 60%. So just know that these are very liquid. They are literally the lubrication for the financial system. This is where cash moves through, how it moves in the system. So it has to be fluid. It has to be very safe, because if it isn't, then the money market is screwed. Just when you're looking at money market funds, you're going to want to look at the things we always look at with ETFs, which is stuff like, your expense ratio, things like that. Make sure it's not high. As you can see here, 0.1%, very low, not going to be a big issue. Now, a lot of money market funds are going to have investment minimums. As you can see here, $3,000. Just make sure that you're able to meet that minimum if there is a minimum. I know there are some out there that have very low minimums, if any. Just make sure that that's something you look at to know that you can invest in it. And our last item is going to be the good old-fashioned treasury bill. Again, technically there is risk involved because the government could default on its debt, but that is very unlikely to happen. With treasury bills, as I've talked about before, I would look at short-term bills. Again, you can go long-term, but as we can see the rates here, shorter term is going to do better. You can see your 1 month is sitting at 4.5%, 3 month at 4.7%, a year almost 5%. Then we get lower out into the 30 years because people are thinking that rates are going to go down in the long term. I mean, at the super long term that might happen, but not really. in the short term. I still see rates rising, but you all know me. That's the kind of thing I think about. When it comes to T-bills, I would say you're buying to buy to maturity, so you're going to need a Treasury Direct account, which I've talked about earlier. And this is, again, just a way to hold your cash. The great thing about T-bills is that if you live in a state that has state income tax, there will be no state income tax for this, because it is what's the word? It's forgiven. It's not. States aren't allowed to collect income tax on Treasury obligations from investors. So you just pay federal income tax, which can be very good if you're in a high tax bracket. And that is going to be about it for our short-term where you can hold cash in the current environment. These are things that in the current environment, they're going to maintain their value. It's very unlikely that you're going to lose money. They're either insured or they are created in such a way that you aren't supposed to lose principal. Money market funds, treasury bills, stuff like that. Very safe, as safe as you can get. If you're a little sketchy about the economy, about the market, stuff like that, like I am, these are good places you can park your money. As always, thanks for watching, and I will see you guys next time.